And welcome to our webinar on MACD, sponsored by Trade Time, one of the world's leading providers of Forex and CFD trading. Now, if you want, during class, if you go to www.tradetime.com, you can open a demo account and follow along using the charts on their platform. Now, tonight's class is being recorded, and you can see a recorded version of this class, an unedited one, by using the same link you used to come to tonight's class in about 24 hours. Or you can check down the road and see an edited version of this class once it's ready at www.investing.com under the Education tab, and then look for Webinars on Demand. And you can go there and see all the classes we've ever presented and watch at your convenience. Now, tonight we're going to be discussing MACD, one of the most respected technical indicators in the marketplace. Now, MACD was originally created for trading in the stock market, but it's been adjusted and accepted as one of the best Forex and CFD and even cryptocurrency indicators. It is used to spot changes in the strength, direction, and momentum, as well as the duration of a trend in an asset's price. The MACD is one of the most popular and broadly used indicators in Forex trading. The letters MACD, which is really nice to say MACD, it stands for Moving Average Convergence and Divergence, which is a big mouthful. Now, the MACD indicator is based on moving averages as its input and falls into a group of what we call lagging indicators. Now, I know in English, lagging and leading have connotations. Most of us think that leading would be a better thing than lagging, and lagging is something that falls behind. But when we come to technical indicators, leading indicators precede the market, where lagging indicators confirm what's happened in the market. And MACD falls into the group called lagging indicators. But MACD serves many purposes, and tonight we're going to see how you can use crossovers, convergence, as well as divergence, and get overbought and oversold signals and entry signals from MACD. Now, the basic function of the MACD indicator is to discover new trends and to help identify the end of current trends. Now, divergence is a popular way to use MACD and the MACD histogram, which we're going to learn how to use this evening. But before we can understand how to use MACD, we have to understand where all the lines come from and how it's actually put together and constructed so that you can help spot inaccuracies or problems or market divergences. Okay. Now, I have tried over the years many ways to make this as interesting as I can. And I will try to do that. But this little part of explaining all the pieces that make up MACD is a little bit wordy, but we're going to get through it. And once you've got it, we'll never have to discuss it again. You'll never have to calculate it. There's no mathematicals you have to do. You just drop MACD on the chart. But you have to understand where each one of the lines come from. So MACD starts out using a 12 and a 26 period EMA, exponential moving average. Now, most of us know what a moving average is. Okay, if we have a 10-day or 10-period moving average, we would take the close of the last 10 periods, add it together, divide it by 10. Now, an EMA simply gives a little bit more weight to the most current movements. And there's many different kinds of moving averages. You have weighted moving averages, volume weighted moving averages, SMAs, EMAs, and in this case, we're using an EMA. Also, if you understand moving averages, the shorter the period of that moving average, the faster it reacts to more recent price movements. The longer the period is, the slower it reacts. Now, it doesn't matter if you're using a 10 and a 20-day, a 1-day and a 1 week. It's always going to be the shortest time frame, or the shortest period is the fastest. And it's referred to as the faster moving average. Now, in this case, we're using a 12 day or 12 period. And when I say day, it's because the standard moving average is 1 day. But if we're using a 1 hour chart, it's 12 1 hours. And we get these on a chart. Let me take you over to a live chart. And let's see if we can make this a little bit more interesting. Now we're looking at a standard gold chart for no other reason except I use this one for class. Now, if we were to drop on a 12 period and a 26 period moving average on this chart, which I've already got set up, and see, I've just dropped them on the chart. That's the blue line and the orange line. Plain simple moving averages. But if we were to use these and use the crossovers of these moving averages, we'd just be trading a simple moving average crossover strategy, which really is a very basic strategy. This is just a starting point for MACD. So what MACD does, it takes the difference between the 12 and the 26 period EMA and subtracts the longer EMA from the shorter EMA. Now, whenever we get a crossover, like right here, or right here, what would the difference be? It would always be 0, because when the two lines are crossing each other, they're the same value, and the value, one value crossing the other value minus the other value is always 0. When the shorter EMA crosses above the longer EMA, it would always be a negative number, because we'd be subtracting this blue, we take this blue number and we would subtract the orange number. So if we're subtracting a larger number from a smaller number, it's always going to give us a negative. If the blue line, which is a 12 period EMA, is above the orange longer period EMA, it would give us a positive number because it's a larger number. So in this case right here, we have the short-term EMA down here, so it's a lower number. And if we were to take this number here and subtract the larger number, it would always give us a negative. Okay. So we take the difference between these two numbers and we plot them down below. Now we would go up to indicators on whatever platform you're using and find the indicators and just locate MACD and click on it. Here I've already got it set up. So the first part of MACD, which is the blue line down below, is simply the difference between the orange line and the blue line on the chart. And if you notice, MACD, when you set it up, will always have a 0 point. And this 0 line is exactly here. When it's touched here, look at the difference. When it touched here, at every time it hits the 0 line, the two lines are crossing each other, because when they cross, they're at 0. And again, if the longer EMA, which is the orange line above, is higher than the shorter term EMA, it would give us a negative number. So we can see the MACD line down below dipping, because this number is here, we're subtracting that number, and it's below the 0 because it's a negative balance. Now, this is just the first step in creating MACD. Now, when you put MACD on your charts, you won't see the EMAs because they're not necessary. They're only necessary for the calculations. So they're gone. They're not on our charts anymore. So now what we have is the MACD line down below. And the MACD line is simply the difference of the two lines that were above. But then, again, like I said, we would be just trading a crossover strategy, and this line moving around wouldn't really give us any information. So we take it one more step, and we create what's called the MACD signal line or the MACD trigger line. And that line is a moving average of the blue line using a 9-period moving average. And that's called the signal line. We simply drop that on the chart below. And then when the MACD line crosses the signal line, it gives us a transaction signal, either a buy signal or a sell signal. So what do you think we got here when they crossed over? Now, when they cross over, they're both all at zero all the time. Whenever you have a crossover and you're subtracting one from the other, you're always going to have zero. But this gave us a buy signal. When it crosses over and moves up, it's giving us a buy signal. When it crosses over and moves down, it's giving us a sell signal. And these are one of the transaction signals generated by MACD. And we'll go over this in more detail. We're just getting this on our charts right now. The third part, or the last part of MACD, because MACD is a 4-step derivative. Okay? A derivative is each time you massage the data. So we started out with the 26-period and the 12-period EMAs. Then we subtracted one from the other to give us the MACD line down below. And that is now 2 steps away from the original price. Now, we added the trigger line on, which gives us a 3rd step away from the actual price action. And now we add what's called the MACD histogram. And the MACD histogram is simply the difference between the MACD line and the trigger line. So on the histogram, the MACD line and the MACD signal line always at a crossover will be 0. So it will always be 0 on the histogram. The histogram will rise as the price rises, as well as the MACD line rises, and the MACD line rises as the short-term EMA gets larger. And you can actually see the depth of the move in the peaks and the valleys created on the histogram. Now, like I said, once we've gone through this, you never have to do any of it again. You just simply click on MACD and it drops it all on your chart for you. Okay. Now, a lot of us only use the histogram because everything you want to know is actually within the histogram. So technically, you could turn off the MACD line and the signal line and just make your decisions from the histogram. But a lot of us like to see everything. So we leave on the MACD line and the signal line. Well, now that we have this on our charts, we sure need to figure out what to do with it. Now, I have attached, or in this class right now, this is a live class. In this class right now, there is a downloadable button on your screen. I have put together a guide or a handout that goes over all of this that I just explained, as well as how to use this indicator, because you're not going to remember everything from this class. So I tried to put it together using all the examples and other people's examples and everything I could find that would make it interesting and easy for you to follow. But the only place to get this guide is in this live class. So please click the download button now and download it to whatever, whether you're using a mobile device, a tablet, you can download it and then move it around to wherever you want to move it later, but you will not have access to it any other time. So if there's anything you missed in the class you're not sure about, it's explained to you in that guide that I've put in the handouts tonight. And we're not finished yet. We're just starting to go over this. We've got the MACD on our charts now. So let's go back now that we have it and try to figure out what value this is going to have to our trading. So let me take you back to our PowerPoint. Okay. So the MACD histogram is just simply an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD line is above the 9-day EMA and negative when the MACD line is below. If prices are rising, the histogram grows larger as the speed of the price movement accelerates and the contracts as the price movement decelerates. The same principles work in reverse as prices are falling. So the moving average convergence and divergence indicator is both a momentum oscillator and a price-based oscillator, and is one of the more reliable studies that we have. While it is a lagging indicator, it works well in all time frames. So if you're trading fast-paced CFDs and using a 15-minute time frame, whether you're a day trader using a 1-hour time frame, or you're a slower investor or a swing trader, MACD will adjust well to whatever time frame you are trading in. And it is a highly interpretive probability signal that is based on the difference existing between 3 moving averages and its histogram. Because you have 3 moving averages, you have the 26 and 12 on the chart, then you have the 9-day EMA of the signal line. So there's 3 different moving averages. Now, while it is slower than momentum indicators such as stochastics and RSI, it is actually more reliable. You'll find by sacrificing this little bit of speed that you get much more reliable signals. So notice that MACD helped traders notice the trend change at very early stages. So if you look on this chart to the left, you'll see that what happened is the MACD, even though it follows as a lagging indicator, it gives you it lets you clearly see that the trend has actually changed. So this is a key part of the indicator and something we will delve into deeper. Using MACD as a trigger into trades, but before we get to that, you'll probably notice that the 0 line drawn on the MACD indicator, this is a key part of the indicator. So it shows us when there is no difference between the EMAs. MACD will cross the 0 line as the faster moving average intersects the slowing moving average. Now, MACD can be helpful for noticing potential trend changes at very early stages. And this is where the signal line comes into play. The signal line is simply a moving average built on the value of the MACD. By default, the value is set at 9 periods. Building on the relationship of the MACD line itself, traders will often look for entry opportunities when the MACD crosses the signal line. And the very basic explanation, or the very basic signal, is when the MACD line crosses above and over its signal line. So in other words, when it crosses 0 and goes over or upward, it generates a buy signal. When the MACD crosses below the signal line, hits 0 and starts going down, it is looked as a sell signal. So in an effort to more closely follow the relationship between the MACD and the signal line, traders will use a histogram, which is simply a bar chart plotted around the 0 to indicate the relationship between the MACD and the signal line. So the histogram just gives you a more clear-cut visual representation of when those two lines are touching and crossing. Now, once we have this on our chart, MACD tells us three different stories, as I mentioned earlier. It will show us convergence, it'll show us crossovers, and it'll show us divergence. So we've already touched on the easiest one is the transaction signals, the buy and sell signals. So these are crossovers. The basic MACD trading rule is to sell when the MACD falls below its signal line, or buy when the MACD crosses above. So as shown in the chart to the right, you can see when the crossovers occur and how the price reacted. And it's a very reliable signal. Now remember, no indicator works best on its own, and they always work best when you regard and look at price action, because they will give you false signals. So you should always be paying very close attention to price. But you can see here on this chart of IBM how reliable this signal has been. The thing about MACD that you have to keep in mind is even though it gives you clear buy and sell signals, it's not telling you that you can execute a buy or a sell, because it's got no risk management, no money management tied into it, and it's not taking into account how far up or down that asset's going to go. So just because it generates a buy signal doesn't mean you should buy. It's alerting you that it's giving you a buy signal. Then you should do the other things you have to do to make a trading decision, because it is very reliable when it says it's a buy. But think of it, like I said, as a buy alert. You have to use other indicators as well as looking at price action, but you also have to determine if it's going to move enough in the direction to cover your spread and make a profit for you, or is it only going up a little bit? Because MACD will give you, especially in a fast moving asset, can whipsaw you in and out of trades very, very, very quickly. Now the MACD also serves as an overbought and oversold indicator. Now remember, overbought and oversold markets don't mean buy or sell. An overbought market can remain overbought for quite a long time. An oversold market can remain oversold. It just means the price has moved up too fast and is too heavy that it is losing its momentum. So think of it as a rocket or fireworks shot up into the sky. It's going to go up and up and up, but at some point it starts losing its momentum, and you know as it loses momentum, at some point it's going to turn down. But when you're sitting down on the sidewalk watching the fireworks display, you don't know exactly where it's going to turn down. You see it starts moving up slower, but you're not sure exactly, but you know it's losing its momentum. And flip it over and the same happens for bearish. So when the shorter moving average pulls away dramatically from the longer moving average, the example is the MACD rises, it is likely that the symbol or the asset price is overextending and will soon return to more normal, realistic levels. And then lastly, it also gives us divergence, an indication that the end of a current trend may be near is when MACD diverges from its symbol. So in other words, when price is moving down, like we see in this chart, and price is making lower lows, but the MACD line, not the signal line, but the MACD line itself is not making lower lows. Here we see the MACD line is actually making higher lows, while the MACD line itself, the price action itself, is moving downward. Therefore, we have bullish divergence. Now, when we get this divergence, it's telling us this trend is coming to its end. We don't know exactly where it ends, but looking for a crossover at that point can be very advantageous, or combining with other details and other indicators. So the moving average divergence indicator is making new highs while price fails to reach new highs. A bearish divergence occurs when the MACD indicator is making new lows, the exact opposite. But when this occurs, it's a very strong indication that trend is ending. So here we see the exact opposite on this chart. So here we have bearish divergence. We see the price action moving up, making higher highs, while the MACD line itself is making lower highs. At some point, we get a crossover, and especially if we look at support and resistance levels, it will give us a very clear-cut indication that that trend is officially over. So remember, we've got 4 deviations from the first price action, and this gives us the final histogram. The first derivative is the 12-period moving average EMA and the 26-period EMA. From there, we go to second derivative, which forms the MACD line, which is a 12-period EMA minus the 26-period EMA. The third derivative is the MACD signal line, which is a 9-period EMA of the MACD line itself. And then we go to the fourth derivative, which is the MACD histogram, which is the MACD minus the signal line, which gives us that bar on the histogram. The base for the indicator is, of course, the securities price. It takes 4 steps to get from the actual price to the MACD histogram. It's an indicator of an indicator. Therefore, it's designed to anticipate signals in MACD, which in turn is designed to identify changes in price momentum of the underlying security. Now, as with the MACD histogram is also designed to identify convergence, divergence, and crossovers. The MACD histogram, however, is measuring the distance between the MACD and its signal line. The MACD histogram crosses the 0 line when the MACD crosses below its signal line. Sorry. Now, it has become standard, as I mentioned earlier, to interpret these transaction signals, which is one of the first things that everybody jumps on. Everybody's looking for buy and sell signals. They think, it's telling me to buy. I'm going to jump in the market and buy right now. So as I mentioned, think of it as a buy alert, because it's become standard to plot a separate moving average alongside the MACD, which is used to create a clear signal of shifting momentum. The signal line, also known as the trigger line, is created by taking the 9-period moving average of the MACD. As you can see over here on this chart, transaction signals are generated when the MACD line crosses through the signal line. The bullish signal line, or a buy sign, occurs when the MACD line crosses above the bullish MACD crossovers that occur when the indicator is below 0 should be aware that they are attempting to profit from a change in momentum direction. While the moving averages are still suggesting the security could experience a short-term sell-off, this bullish crossover can be correctly predict the reversal in the trend, but it is often considered riskier than if the MACD is above 0. So as mentioned earlier, the MACD indicator is calculated by taking the distance between the short-term and the long-term EMA. In the previous examples, the various signals generated by the indicator are easily interpreted and can be easily incorporated into any short-term trading strategy. At the most basic level, the MACD indicator is a very useful tool that can help traders ensure that short-term direction is working in their favor. In other words, MACD will always make sure or help you understand that you're trading in the direction of the trend. Now, the biggest drawback of using this indicator to generate transaction signals is that a trader can get whipsawed in and out of a position several times before being able to capture a strong change in momentum. As you can see in this chart to the right, the lagging aspect of the indicator can generate several transaction signals during a prolonged move, and this may cause a trader to realize several unimpressive gains or even small losses during the rally. Traders should be aware that the whipsaw effect can be severe in both trending and range-bound markets because relative small movements can cause the indicator to change directions quickly. The large number of false signals can result in the trader taking many losses. When commissions are factored into the equation, the strategy can become very expensive. So that's what I said. Be aware that you can get a lot of buy signals, but it doesn't tell you it's going to go long enough for you to stay in the market to make profit. You need to use other pieces of information. Now, the MACD indicator is the most popular tool in technical analysis. It is the most widely used indicator in CFD and Forex trading because it gives traders the ability to quickly and easily identify the short-term trend direction as well as changes. The clear transaction signals help minimize the subjectivity involved in trading, and the crossovers of the signal line make it easy for traders to ensure that they are trading in the direction of the momentum, because that's very, very important. Distinguish the crossover signals as telling you a shift in the momentum. Very few indicators in technical analysis have proved to be more reliable than MACD. And this relatively simple indicator can quickly be incorporated into any short-term strategy. So if there was ever a quest in the world of investing on par for the search of the Holy Grail, it would be acquiring the ability to spot trend changes. There are many ways investors attempt to do this with varying degrees of success, but a common trend tracking tool is the two-line moving average convergence divergence tool. This tool measures an asset's momentum and can aid investors in spotting changes in market sentiment. Now remember, momentum, as I explained with the fireworks shooting up in the air, in charting is similar to momentum in physics. If you throw a ball in the air, it will ascend at a slower and slower pace the higher it projects. After monitoring the changing momentum, a person can determine when the ball will stop climbing and change direction and descend back to earth. So if we're sitting down visually and watching that firework go up, we can see it going up and up and up. We can see that momentum waning, okay, but we can't guess when it's going to actually flip over. But if we had a paper and pencil and some mathematics and a computer, we could then gauge when that change should occur and it's going to reverse down. And that's what the MACD does. So just like in physics, momentum changes occur before the price of an asset changes. Now, there are many ways to use MACD. Channeling the MACD line also works very well. But this is a way of interpreting it that you might want to use in your trading strategy. But also, MACD works extremely well when combined with support and resistance lines. So you can also use the MACD histogram for both entry and exit points. To resolve the inconsistency between entry and exits, a trader can use the MACD histogram for both trade entry and trade exit signals. To do so, the trader trading the negative divergence takes a partial short position at the initial point of divergence, but instead of setting a stop at the nearest swing high based on price, he or she instead stops out the trade only if the high of the MACD histogram exceeds its previous swing high, indicating that momentum is actually accelerating and the trade is truly wrong on the wrong side of the trade. But on the other hand, the MACD histogram does not generate a new swing high. the trader then adds to his or her initial position, continually achieving higher average price for the short. But like life, trading is rarely black and white. Some rules that traders agree on blindly, such as never adding to a loser, can be successfully broken to achieve extraordinary profits. However, you need to have a reason for violating these and important money management tools to establish before attempting to capture gains. But remember, one of the most important rules is the trend is your friend, and you always want to be trading with the trend in the direction of the momentum. So in the case of the MACD histogram, trading indicators said the price offers a new way to trade an old idea, divergence. Applying this method to the Forex market, which allows effortlessly scaling up of positions, makes this ideal for day traders and position traders alike. So as I said, MACD is not difficult to put on your charts. It's not even really difficult to incorporate into your trading strategy once you learn the fine variances of its little quirks. And you need, in that handout I gave you, actually covers all this, gives you examples, and shows you how to apply this to your everyday trading. And hopefully, you're not going to remember everything we talked about in class. We skirted over a lot of things, but that handout does cover it all. And you can start slowly incorporating MACD into your trading. If you want to learn more about MACD, you can go to the education section at tradetime.com, or you can talk with one of their financial analysts who will work with you one-on-one to explain exactly how to apply MACD to your charts. So thank you very much for joining us tonight. Thank you for supporting Trade Time as well as investing.com. And we'll talk to you again real soon. Good night now.